Panicking is not going to help at this point in time. I think switching to cash is really dangerous because if you're in the Australian stock market, you've lost around 27 or 30%, but your super fund hasn't lost that kind of money because very few people in super are 100% invested in stocks. A lot of people are in balanced funds. That's 60% exposure to the stock market. So you might be down maybe 15% or something like that. The other parts of your super would be still doing okay. The valuations could have gone down, but the actual income coming in is all good. I just think it's just too early days, Pete, to think about doing anything drastic. And I know some of my closest friends have been ringing me up asking whether they should be buying the stock market right now. And I say to them, it's probably too early. Remember the GFC, the stock market went down 50%. We're down about 27%. I don't expect that to happen because Lehman Brothers was the real jolt when a company of that size, that financial institution of that size, was basically allowed to fail. That's when the markets really got panicky and it went down, to that extent. At the moment, central banks and governments are working together, and that's good. And the stimulus packages are coming through. I think they need to be ramped up, the stimulus packages, only because, not because of the coronavirus so much, but because of the policies that have been put in place by governments around the world to contain the virus. They're far more extreme than people would ever imagine. You guys asked me about 2 or 3 weeks ago, what should the package be like, the stimulus package, and I said at least $6 billion, but I never expected the level of lockdown that has been proposed by so many countries, including our own, to have that kind of impact on the economy. Josh went for $17.6 billion last week. That was a good number. But the lockdown factor has become so serious, I think he has to go for a much bigger number.
Yes, well, this next second stimulus package is being touted as the safety net package. I don't know what that number would be, but it is certainly scalable on that $17.6 billion. Josh Frydenberg has also spoken to some of his G20 counterparts overnight, the US, the UK, Indonesia, Canada, Saudi Arabia, who's the president of the G20 at the moment. This is all in an effort to get an emergency meeting underway and actually coordinate in some kind of way stimulus and what central banks are doing. How important is that, Peter Switzer? Because during the GFC, it was George Bush who assembled G20 finance ministers as soon as the Lehman Brothers collapsed. That hasn't happened this time round.
No, look, unbelievably crucial. But one thing I will throw in is that the first leg down for the GFC was actually in November 2008. And the behaviour of central banks was ridiculous. Our own Australian Reserve Bank raised interest rates in February. I was writing for the Australian then, and I just could not believe. I think I might even use the headline, what are these guys smoking? It was just crazy. And then we had to go all the way to September 2008 before our Reserve Bank then cut interest rates, the first in the world to do it. And then, of course, all the other issues came out. I think we are ahead of the curve in terms of central banks and governments responding, but I do think a coordinated response, was a suggestion from Josh Frydenberg, is absolutely spot on, and I think it gives confidence to the markets if something like this happens. And so even though it seems kind of delayed, Laura, in terms of the historical comparison of GFC, we're miles ahead in terms of anticipating what could go wrong and what needs to be done to make sure that after, say, a month, and I'm hoping that the worst of all this is a month, and then we start seeing markets rebounds, convincingly, and then the economy starts kicking in because of those stimulus packages.
Pete, just quickly, for the retirees out there who are concerned at the moment about their superannuation getting battered, what can you say to ease their nerves?
Yeah, if you look at the history of the super funds in this country, the balanced super funds over a 10-year period have returned around 7%, and over a 15-year period, 6.3%. I've recently shown a graph to the people who follow me on Switzer Daily, and I showed them over 27 years of superannuation, only 3 years have been negative, which means that the rebound year after a crash is always quite substantial, and after after the GFC, guys, between March of 2009 and December, our stock market rebounded 36%. So I really think just don't worry. Have faith in your superannuation fund or your financial advisor who should have put together the right kind of policy that will see the rebound when it comes.
Okay, good advice as always. Peter Switzer, thank you. We'll talk to you soon.